Hey traders, this is Blake Morrow with Trader Summit, and I'm really excited today to bring on somebody that I wish he would have been here, years ago, but now's as good a time as ever. I'm going to bring in Jared Dillian he is the editor at the Daily Dirt Nap. Jared, nice to meet you. Nice to see you, and welcome to the Trader Summit.
Hey, thanks for having me.
I get requests all the time to have certain people on, and I've had multiple requests for you over the years. So I'm really glad we got to connect. I think a lot of our traders, which mostly are retail, but we do have some institutional traders, around our community, really wanted to hear from you and kind of learn a little bit more about what you do. So could you do us a favor and tell us a little bit about your background for people that maybe don't are not familiar with your name?
Sure. Well, I went to the Coast Guard Academy for undergrad, studied math, and served in the Coast Guard for 9 years. And while I was in the Coast Guard, I got my MBA from the University of San Francisco. Um, I spent a couple years on the options exchange in San Francisco, the P Coast. And then I got hired by Lehman Brothers, went to New York, and I did 3 years trading index arbitrage and 4 years running the ETF desk. So I stayed there till the bankruptcy, had a great career at Lehman. It was fantastic. And left at the bankruptcy to start the newsletter, the Daily Dirt Nap. Been doing that for 16 years.
Wow.
It's an institution at this point. Like it's pretty well known. Um, I've written 4 books. The first one, Street Freak, which came out in 2011, then All the Evil of This World, then Those Bastards. And the most recent one is No Worries, How to Live a Stress-Free Financial Life, that came out in January. I have a fifth book coming out in November, which is a short story collection. I was an opinion columnist for Bloomberg for 5.5 years. I wrote for Forbes, TheStreet.com. I teach at Coastal Carolina in the business school, and I'm a DJ, as you said. I'm a progressive house DJ. So
that that is a heck of a rap sheet, Jared. I love it. Now, your third book, which was "Live a Free Financial Life," is that correct? Is that the correct title?
stress-free financial life.
How do you do that as a trader? So explain to me how that
Well,
works.
the funny thing is that I kind of compartmentalize my life. Like I have two screens in front of me. You're on one of them, and my Bloomberg Launchpad is on the other. So whenever I do interviews, I'm always looking over to see what's, checking the markets like every 30 seconds. Um, but generally, I don't feel stress about money. Like even, it's funny, like the last 3.5 years I've been building a house. The house, I literally just moved into it 2 weeks ago. This is the new house that I'm broadcasting from.
Congratulations.
Um, yeah, and building a house is a lot of financial stress, and it's a little bit over budget, and it's kind of stressing me out. But the point is that I don't, unless I'm sitting in front of the screens, I don't think about money all the time. I don't lay in bed at night wondering if I'm going to make the mortgage payment or the credit card payment or anything else. Like I just don't stress about money. So.
Do you think a lot of that has to do? I mean, I want to talk a little bit about your experience because I think this is where a lot of traders, especially, let's call newer traders and newer traders, I think you and I would both agree we could classify anybody that's been in the markets less than 10 years is probably even a newer trader to a certain extent. But your extensive background is probably trading and managing risk and being all about position sizing. Do you think that plays a big or a small part in what you do?
Oh, big part. Position sizing is one of the hardest things. I would say position sizing is one, and the decision of when to sell something is the other. Those are the two hardest things about trading. There are two position sizes, too big and too small, right? If it's a winner, then you were too small, and if it was a loser, you were too big.
Right.
The funny thing is that I actually have a position right now, which is actually the right size. So, I'm pretty well versed in Argentina. I did a lot of work on Javier Milei even before the press picked up on him. I built a position in some stocks in Argentina, and I'm pretty big in these positions, and they've done well. They're up close to 200%. But if I were any bigger, it would be irresponsible. You know what I
Yeah.
mean? I don't know if you've ever been in that situation. You've been in a winning trade and you're like, gosh, I wish this was bigger. But if it were bigger, then it would be causing me stress, right? The
Yeah.
P&L variation would be causing me stress. So
That's right. Jared, I work with a lot of individual traders, one-on-one, and one of the things that I want to get your point of view here, and then we can talk a little bit about. I had a question from a interview or the briefing that you did yesterday on Real Vision, but when I trade, I would say that, and I trade quite actively. I'm a swing trader, you could define me as, but I'm probably in and out of positions multiple times a day, and some positions I'll run for a week or two. It's pretty much the way I approach things. But throughout the course of a month, I would say in a month's time, I probably have uh, anywhere between one to four trades that really make up the bulk of my P&L, win or loss, but the bulk of my P&L, because it's an idea that I have. And a lot of the rest of the trades that I do is, it's just kind of staying loose, staying limber, just trying to get, just manage around the markets, keeping a pulse or a beat on pulse on the beat, however you want to say it. But it's really only a couple of times a month that I size up a position to a point where, you get to that level where you're like, do I have enough? Do I have too much? Am I going, and now I have to really focus on managing that. Do you see the market in that sense, or are all your positions pretty much the same size for the most part?
oh no, absolutely. Like my stuff is weighted by conviction. If I have high conviction in something, it's a big position. It's conviction and risk,
Yeah.
right? So it's conviction and volatility. So even if I have high conviction in something that's very volatile, I have to make it a smaller position because of the volatility. So it's really those two factors.
That makes sense. Okay. Well, I heard something that you said yesterday, and it really, like I said, it resonated. Like I told you just before we hit the record button, it resonated with me. And you said something to the effect of, we are a product of how we started. I started trading and when it was 1996 is when I sat down at a trade desk for the very first time. But I was trading internet stocks as they were flying around, very low liquidity. Stocks could be up, 10, 15, $20 intraday on 30,000 shares of volume. But I'm used to, or I grew up in that environment. And you said something yesterday that you kind of grew up around the same time, but you witnessed stocks really coming down. So that tailored the way that you and shaped the way that you approach the market, even in today's date. So can you tell us a little bit about your concept there and why that stuck with you?
Yeah, I mean, I'm sort of a child of the bear market, and I started a little after you. I started in 1999, November of 1999, 4 months before the top,
Yeah.
right? So, I got hired by Lehman in 2001, and the first 2 years of my time at Lehman was a terrible bear market. Um, and for the rest of my life, I have had a short bias, and it's not because I'm a pessimistic person. It's not because I think bad things are going to happen. It's just because that's the environment that I grew up in when I started trading. I like for the first 3 years of my career, stocks only went down,
Yeah.
you know, and so, that's generally where I look for opportunities. I mean, with the markets today, Dow hits 40,000 today, new all-time highs. I mean, sometimes I sit here and I'm like, I should just be long, but I look for opportunities to short. Actually, during the pandemic, I actually had a big score because I bought some very cheap S&P puts a couple of months before the pandemic, incredibly cheap S&P puts that went like 30 or 40x during the crash.
Wow.
So that's that's not all that I do, but that's the stuff that I like to do,
Well, you know, in your defense, you think about pre-pandemic. I mean, we were on the cusp and I would actually argue that we were in a recession as the pandemic was starting.
Yep.
The economy was rolling over. The broad-based economy was rolling over. So good on
The
you.
the
I mean,
yield curve had just inverted.
yeah, yeah. It's and by the way, we just had equities as we're speaking, equities are peeling off right now. And I'm not sure what had just happened as you looked at your Bloomberg and I'm looking at all my charts right now. Things are happening, but hey, you know, let's talk about current environment because I love your approach to the market. I kind of put myself in the same boat as you as far as the way I trade. I've made a lot of money on the short side, and I think a lot of the market has not experienced it. So where do you see us right now? I mean, equities are at all-time highs. Yesterday's CPI, it could have been worse. I personally think the market got squeezed. A lot of people are trying to lean into the short as we were at all-time highs or near it. Where are we at right now? What do you think's the best play?
Yeah, there's a lot there. So first of all, you're right. Like positioning was very short going into CPI, especially in bonds.
Yeah.
Um, for the last couple of months, we've seen the inflation really pick up. At least anecdotal measures of inflation, like commodity prices and stuff like that. So people had expected sort of an ugly CPI print, and it ended up being an inline number, and the bond market got waxed. So whenever you see a piece of data come in line and something gets waxed, like where positioning is. Sorry, the bond market ripped. I got to get it
Yeah, it
backwards.
ripped
Yields
and
got
yields
whacked.
fell. Yeah,
Yeah.
yeah.
Yeah. So where are we today? Well, one of the things that I've been, first of all, let me back up a second. And my trading style is different from yours. It's very long term. I think in terms of years,
Oh,
right?
okay.
Like at a minimum 6 months, but often out to 5 years. So I really go big game hunting on big investable trends, right? And one of the things that I've been looking at recently is private equity. And I think that private equity is in a massive bubble, a huge bubble. Now, this could take a long time to play out, but this is something, when I play something like this, I'm not playing for teenies and eights. I'm playing for,
Yeah.
big, you know, big payoffs. So
Did you just say teenies and eights?
yeah.
Oh, you are so old school. I love it. I love it. Then you're gonna start throwing 30 seconds out at me, and I'm gonna just go spinning. That's awesome. But how? Okay, so I get your concept. I understand your concept. It's kind of like when we stood at the top of the rooftop in 2007 and said the housing market's going to collapse. How do you take advantage of private equity on the short side?
Well, there's really three big private equity firms that are publicly traded. There's Blackstone, KKR, and Apollo, right? So I've been focusing on Blackstone because it has the real estate portion as well. Blackstone is really it's half real estate and half private equity, and all of it is a horror show. You probably saw the Business Insider piece that came out last week about B REIT, right?
Yeah.
So, look, like private equity made sense, 5 years ago when interest rates were at zero and you could buy companies at like 4 or 5 times multiples. And now interest rates are at 5% and you're buying them at 10 or 12 times multiples and there's nobody left to sell to. Like it does not make any sense. And if you think about this, like Buffett has 189 billion in cash and there's nothing he wants to buy, and the private equity guys think everything looks good, like they're buying everything like that. That's all you need to know you
Right.
know
That it's that's an interesting play on the markets, and I see exactly where you're going, and it's like um a lot's changed. And I think the world's having a hard time coming to grips with the idea that rates are going to stay higher for longer. I mean, do you see it that way as well?
um I think it's more nuanced. I'm sort of I think rates could be lower in the short term, but higher in the long term, right?
Yeah,
And there's a lot of very vocal and annoying bond bears out there. And like I think they have their time horizon off, right? They're thinking out 5 to 10 years and thinking that tens are going to be at 8 or 9%. But in the short term, tens could go to four, 3.5.
sure.
Um, Especially, I mean, like, and plus, it's kind of hard to see out past November. We have an election coming up, so we have no idea what the world is going to look like 6 months from now. So I think if you have this higher for longer view and you're just monotonically short bonds, you are going to withstand some pretty huge drawdowns along the way. And I'm just not going to be short bonds all the time because I have a 10-year view. Like it doesn't make any sense. So
That to me makes a lot of sense. So, since we're talking a little bit about rates and this probably factor in maybe what some of your views might be regarding the Fed. I mean, where do you stand? Because we are going into an election year, as you pointed out, and here we are, the market's pricing in, the first cut in September. Do you think that's a realistic expectation in an election year, or do you think the Fed may do it? And are they going to be biased politically if they do so?
I mean, great question. I'm kind of agnostic. I mean, first of all, I don't think like 125 basis point cut really matters. I think it really matters only for the Fed's reputation.
Yeah.
If the Fed cuts and they have to hike later, that looks bad for them. So I think they have a bias to not do anything because if they have to take back the rate cut, then they have egg on their face. It's kind of like the Trichet in 2008, if you remember that, right?
Of
When
course.
Trichet raised
What?
rates 3 months before the crisis, you
Yep.
know,
Yep.
so I think they have a bias to inaction. But at the same time, the Fed is politically motivated for sure, 100%. Like that's not conjecture, that's fact. And also something that is also fact is they don't want Trump to be president because Trump interfered in monetary policy during his first term. And if you saw the Wall Street Journal article from a couple of weeks ago, his economic team is drafting plans to weaken Fed independence and maybe even include Trump having a role in setting interest rates. This is not what the Fed wants. So I think the CPI was kind of a gift to the Fed. I mean, like you said, we priced in the cut yesterday.
Mhm.
So sure, I mean they could cut 25 before the election and entirely possible.
Well, Jared, I'll tell you, if they do, it's gonna be. Oh my gosh, you can imagine the uproar, and I think it's gonna be a kind of a tumultuous year, as far as the election goes, how people are viewing the Fed, and whether or not come the beginning of November we have an actual you know president, a sitting president, and who's sitting at that is going to be very interesting. I don't want to make this a political show. But I do want to say that aside from 10-year Argentinian wine futures that you might be long at the moment, what do which would probably not be a bad bet. What is and private equity? Anything else that has that's on your radar right now before I let you go?
I generally am operating under the thesis that US equities are overvalued and international equities are undervalued, right? So I have a bunch of positions and I'm net short US stocks and I'm net long everything else, right? And, with US stocks trading at, I think 26, 27 times multiples and the rest of the world trading at 10 times multiples, like I think that's going to compress over time. So, I'm being very strategic about what stuff I buy overseas. I'm not just buying like EFA or some broad market ETF. I think there's pockets of opportunity, but I want to be underweight the US and overweight the rest of the world and kind of let that guide my asset allocation.
All right. Well, that I appreciate your thoughts there, and I appreciate your thoughts on private equity as well. And now, for more information, traders that are just learning about you, best place to find you?
So a bunch of places. I have a personal finance website called Jared Dillian Money. So you can go to jareddillianmoney.com. There's lots of good stuff there. The newsletter is at dailydirtnap.com. If you go there and you want to subscribe to the newsletter, just mention the podcast and I'll give you a discount. Um, and what else? And I'm on Twitter at Daily Dirtnap.
And I do follow you there. And like I said, I really like your work. I was introduced to you by a friend of ours, Brent Donnelly, and he really is a big fan of what you do. And so I have to say, after meeting you like this, I'm a big fan too. And if you guys and gals are listening to Jared and you like what he says, give him a thumbs up. Subscribe to this channel down below so you don't miss any of this exclusive content. But jump down in the comments if you happen to agree with what Jared has to say. Jared, I want to thank you for spending your time with us here on the Trader Summit, and I hope to have you back in the coming months, and we can kind of see where we sit after the summer passes us by.
Yeah, love to be back. This is great. Thank you.
Yeah. Well, great having you here, and thank you very much. And I'll catch you on the next one. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.